Hello, 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 hello. Thanks for being here tonight. My name is Jennifer Wright Cook. I'm the Executive Director of The Field. My pronouns are she, her, hers. I'm going to do a visual description for accessibility purposes. I'm a light-skinned white woman with brown, medium long hair, big glasses with a white, mostly white backdrop. I want to introduce Natalie Marmel, who's our tech support staff and accessibility point person. If you have any needs, you can talk with her in the chat and we'll do our best to support that. I also want to introduce Aisha, who is our ASL interpreter for tonight. And if it's helpful to you, you can pin Aisha so you can see her very clearly. And thank you so much for Aisha for being here tonight with us. Natalie is going to put in the chat our value statement, which was also emailed to recently. And I'm going to go ahead and read our land and labor acknowledgement verbatim from that document. So if you want to follow along, you can open that document as well. The Field recognizes that its office is located in Lenapehoking on the island of Mannahatta, and that this is the unceded homeland of the Munsee Lenape peoples. We acknowledge and pay respect to the Lenape community, their elders, both past and present, as well as future generations. The Field was founded upon exclusions and erasures of Indigenous peoples, including those on whose land our office is located. This acknowledgement demonstrates a commitment to beginning the process of working to dismantle the ongoing legacies of settler colonialism. Labor acknowledgement. We must acknowledge that much of what we know of this country today, including its culture, economic growth, and development throughout history and across time, has been made possible by the labor of enslaved Africans and their ascendants who suffered the horror of the transatlantic trafficking of their people, chattel slavery, and Jim Crow. We are indebted to their labor and their sacrifice, and we must acknowledge the tremors of that violence throughout the generations and the resulting impact that can still be felt and witnessed today. We must also acknowledge their artistic practices, which in many cases is the basis for our dominant forms of contemporary popular culture today. These acknowledgements are, of course, more than words on paper. They're a call to action, a call to justice. In the chat that Natalie added our value statement, in which we clarify what we've done, what we're doing, and what we hope to do to live more fully into our values. Please feel free to, oh, sorry, I see Natalie, did I get Aisha Simpson, ASL? Sorry if I got that wrong. Please feel free to add your name in the chat, your pronouns, and your land acknowledgement if you're familiar with that. If not, we have some resources in the document as well for that. And that's it for me. I'm going to toss it to our amazing facilitator, Julian Schubach. Thanks for being here, Julian.
Thank you for having me, and thanks everybody for joining. My pronouns are he, him. For visual representation, I am a white man with short brown hair, brown eyes. I'm wearing a purple button-down shirt, and I'm sitting in my office. I have a fake tree in my corner and a nice light over there. And I am broadcasting from the home of the Merrick people. So I'm going to share my screen for everybody. All right, so this is the second episode of our financial planning discussion. If you weren't able to join us for the first session last week, I'm sure you're able to get a copy of that webinar from the folks at the Field. If this is the second time that you're here, welcome. So today we're going to be discussing things including retirement savings basics, retirement accounts, taxes, stocks, bonds, ETFs, a little bit about cryptocurrency because it's the hot topic, and some more. Another thing we'll talk about is risk tolerance. So obviously we're limited on time, and talking about these different items can actually take months, if not years, to learn about all of this. So we're going to do the broad brush overview. If you have any questions or anything that might apply to the group as a whole that would benefit, we're going to do a question and answer section in the end. If you have any individual questions, anything that would be more private that you wouldn't want to discuss with the group, you can reach out either to myself or to the Field or schedule a private consultation, which will take place on Friday. So to get started, let's talk a little bit about retirement. Retirement's a little bit different for a creative or an artist or an entertainer than it is for most people who are working 9-to-5 jobs or have W-2 income. It looks a little different. Income fluctuates. There are different considerations that need to come into play, and there are different types of retirement accounts that are available to you compared to somebody who had different types of income. So the first thing we want to talk about with retirement are your tax incentives. So you have a few different options for you when you're saving for retirement, and they have different tax impacts on you. We'll talk about traditional retirement accounts, which allow you to save tax deferred for retirement and allows you to have a tax deduction each year that you make a contribution to your retirement account. There's also Roth retirement accounts we'll talk about, which allow you to pay your taxes now and have your retirement money grow tax-free forever. We always want to think about Social Security. Currently, Social Security really isn't that much. Really, it's enough to pay minimal amounts of bills. And the honesty is, we really don't know in the future what Social Security is going to look like 30 years from now, if there's even going to be Social Security. So the onus is really on us to save for our own retirement. Something that's really important that needs to be considered for those who are close or considering retirement are medical costs and inflation. Medical costs are one of the biggest expenses for folks who are retired. So it's important to understand how much you have saved for retirement, how that's able to be allocated towards medical costs, and if you're doing things like Medicare or any supplements to help you in retirement. Inflation we spoke about in our first meeting, but we'll cover it again today. And inflation is really your loss in buying power. Things get more expensive each year, especially if you live in one of the big cities. Inflation is even larger than it is perhaps in smaller or rural areas. We see it in New York, LA, Miami, Chicago. Rents continue to go up. The costs of goods, Ubers, anything you could think of becomes more expensive. So it's important, especially for our retirement accounts, that we're saving money in such a way that it's growing at least with the pace of inflation, so that your money can still afford the same things in the future. And that comes back to compound interest. We want to make sure that the money that we have put away for retirement is growing and continuing to compound, so that you're able to continue to afford the same things in retirement that you can today. Long-term growth is what we're always trying to accomplish inside of our retirement accounts, especially for those that have 20 or 30 years until you retire. The longer the amount of time you have until retirement, the more opportunity you have for growth inside of your retirement accounts. And we'll touch on that a little bit at the end. There are different types of retirement accounts available. You have an IRA, which is an individual retirement account. You have a SEP IRA, which is for self-employed people. There is a Roth IRA, which, as we talked about before, is very similar to the individual retirement account, but it has different tax considerations. We have a solo 401k, which kind of looks and smells like your traditional 401k at work, but it's for those who are self-employed or have their own business. And lastly is the 401k and 403b. We're not going to speak too much about the 401k or 403b today, because that really affects folks who have W-2 employment that are working really 9-to-5 jobs. Those are corporate retirement accounts. I really wanted to focus on those of you who have income coming in from either freelance or you're earning 1099 income and you might not have a full-time job that offers a corporate plan. So let's talk about these first four. Your individual retirement account is available pretty much to anybody that earns any income during the year. Your IRA is a retirement account that allows you to put money away for the future. The goal of any of these retirement accounts is to put the money away and pretend it doesn't exist. Yes, in an emergency or if you have a hardship, you can take money out of your retirement accounts, but there are different rules that apply to each of the retirement accounts. To be fair, it's very confusing, right? So I'm always doing ongoing education every year as legislation and rules change about retirement accounts. It's not simple, it's not cut and dry. It's not like there's one type of retirement account that you put money away into. It's complex. So it is good to speak to an accountant or an advisor or a trusted friend that has expertise in this spot. So an IRA is a way for you to put away money for retirement. How does it work? Well, you can open an IRA in all different places. If you have a bank or a credit union or a brokerage account, any of those places you can go and you can ask to open an IRA. Again, the main difference here is this is a retirement account. You can put money away from now all the way until you retire. The trick is, though, you don't want to touch it. So you can put money away all the way up until retirement, but the government's basically saying, hey, we're letting you save for retirement on a tax deferred basis. You get a tax deduction each year. And by doing that, we want to make sure that you're protected and you're not going to abuse this account. So you can't touch this money until you're 59 and a half years old. You can take the money before 59 and a half, but you're going to owe taxes and a 10% penalty. So you really want to know that the money you're putting away for retirement, you're not going to touch. This shouldn't be money that you're going to use for a project or for a car or for moving. This is money that's put to the side and we're not going to think about it. When you turn 72 years old, you have to take what's called minimum distributions, which means the government saying, hey, listen, we let you save all this money for all this time and save on taxes. It's time to start paying some taxes on it. So at age 72, you have to start taking a little bit of money out of your retirement account each year and pay taxes on it. Each year, you can put away $6,000 into your retirement account and an additional $1,000 if you're over the age of 50. These numbers change every year. So next year, it might be different. Let's say you earned $40,000 this year and you put $6,000 into your IRA. You really did earn $40,000, but you only have to pay income tax on $34,000. So you earned 40, you put 6 into your retirement account, tax deferred, you only owe taxes on 34,000 of income. So you get the opportunity to save for retirement, you can defer taxes, and you get a tax deduction each year that you put money away into your IRA. How to save? What do you do once you get the IRA open? The question really becomes, should I put $6,000 or however much I can in at once, or should I break it out over the year? There's no right or wrong way to do this. There's something called dollar cost averaging, which means that if you wanted to put away $6,000 for the year, you could say, hey, I'm going to do $500 every month. I'm going to automate it. I'm not going to think about it. And at the end of the year, when I go to my accountant, I can show them that I already put my $6,000 into my IRA. Or you can wait till the end of the year when you meet with your accountant and put that money away. With your IRA, you have until April of the following year to make a contribution for the previous year. So to give you an example, if you wanted to make a 2021 contribution to your IRA, you can do that all the way up until April of 2022 or until you file your tax return. That's an IRA. A Roth IRA is very similar to an IRA. The difference here is how it gets taxed. A Roth IRA is basically you get no tax deduction. So if you make 40 and you put 6 away into the account, you're still paying taxes on your $40,000 of income. You're getting no deduction on your taxes. So what's the benefit of doing it that way? Every dollar that you put into that Roth IRA is going to grow tax-free forever. So if when you retire, you have $500,000 sitting in your account, in a traditional IRA, you still owe taxes on that. In a Roth IRA, that money is all yours. You owe nothing. There's also no RMDs. There's no minimum distributions at 72 because you've already paid your taxes. So the government's not coming and looking for tax dollars to be sent their way. There's something called the 5-year rule inside of your Roth IRA, which means that if you make deposits, after 5 years has passed on each of those deposits, you're allowed to take that money out and use it. Only the principal though, not the growth. So if you've put away $20,000 over the last few years, you can take that money out if you really need to. But at the end of the day, the goal with a Roth IRA or an IRA is not to touch that money. But it does give you a little bit more opportunity to use it in an emergency. And it'd be very similar how to save, whether you want to make contributions on an ongoing basis or at one time. A SEP IRA is a little bit different. A SEP IRA is for somebody who earns 1099 income, maybe has their own business, they have their own touring, they have their own company, whatever it may be. You're earning enough money that you want to put away more than what you can do into an IRA or a Roth IRA. So let's say you're making $100,000 and you want to put away more than the $6,000 into the IRA. A SEP IRA allows you to set up what seems like an IRA, but you can put away much more. You can put in about 25% of your income up to $58,000 a year. So if I'm making $100,000 a year, there is the potential that I could put away $25,000 that year, 25% of $100,000 into my SEP IRA and get that tax deduction. I made $100,000, but because I put $25,000 towards retirement into my SEP IRA, I only have to pay taxes on $75,000 in income this year. So it's a huge tax savings. The SEP IRA isn't right for anybody. So before you open a SEP IRA, it is important that you speak to your accountant. If you don't have an accountant, I would recommend you speak to one before you open a SEP IRA, because there are some complex rules that come into play there. That's the main difference between the SEP IRA and the IRA. Last would be a solo 401k. The solo 401k is if you have employees or you have an S Corp or a C Corp set up that you're earning payroll from. So if I have a business, that business earns revenue and that business has payroll that pays me W-2 income weekly, bi-weekly, annually, whatever it is. If you're earning W-2 income from your business, a solo 401k could be a good fit. Like the SEP IRA, it allows you to save a much higher amount than an IRA or a Roth IRA. The solo 401k allows you as an individual, as an employee, to save about $19,500 a year. And it allows your business, your entity, your S Corp, your C Corp, your partnership, to put in what's called a matching or profit share contribution, which can be a total of about another $35,000. So if you're not on payroll, a SEP IRA might be a good fit. If you do have payroll through your business that you've established, a solo 401k could be a good fit. Again, I think it's really important that you speak to an accountant or an advisor about which one of these might be right for you. The IRS is really stringent and really tough on people who do the wrong thing here. So if you set up a SEP IRA and you shouldn't have, they can force you to take your money out and even penalize you for the growth that you've made during the year. So before you get these set up, it is good to speak to somebody. We did mention the 401k and the 403b, so I'll touch on it briefly again. The 401k or 403b is if you have a job at a larger employer that has multiple employees that you're not the owner of. So let's say you work for a dance company or a fiscal sponsor or a nonprofit. They might have a 403b or 401k, which allows you to save for retirement. You make a contribution of your liking up to $19,000 a year, and the employer may or may not give you a match. Some employers basically say, hey, if you save for retirement, every year we're going to give you 2%, 3%, 4% as a match, as an incentive to save for your retirement. Some don't. But even if they don't, it's important to save for your retirement. So it is good to take advantage of those plans if they're available to you. Difference between a 401k and a 403b. 403b is used by nonprofits, hospitals, arts organizations, schools. A 401k is generally used by for-profit organizations. So to move on, something that we should talk about is what's better? Should I do the Roth? Should I do the traditional? Should I pay taxes now or should I defer them? There's not a great answer, unfortunately. It's really unique and everybody has a different fit for them. So I'll give you two different scenarios. Scenario one, let's say you're somebody who's ready to save for retirement and you need the tax savings, right? It's important for you each year to get that deduction, to get some money back on your tax return, or maybe you owe a lot in taxes and say, I need some tax savings here. The traditional IRA, 401k, or SEP IRA would be right for you because you get that tax deduction each year and that money's growing tax deferred. So you're going to save on taxes, you'll save for retirement, and you'll deal with taxes in the future when you're retired. If you say, you know what, I don't really have a big tax issue. I owe taxes, but I'm not as worried about my deduction or how much I owe each year. The Roth could be a good fit for you. Why? Because if you pay your taxes now, that money's growing tax-free forever. So when you retire, if you have a nice high retirement account balance, it's all yours. You don't owe anything on it. Every single dollar goes to you. Something to think about is that we're in a historically low income tax rate environment. We can expect that income tax is just going to continue to go up and up. So if you want to capture the current tax rate, you would use the Roth IRA or a Roth 401k to make contributions now, pay taxes now, and let it grow tax-free. But again, there's no one size fits all. It's different for everybody. Again, it's smart to talk to a trusted friend, an advisor, or an accountant about what might be right for you. These are just registrations. These are not investments. This is basically a house or an apartment, your IRA, your 401k, your 403b, your SEP IRA. Think of it as a house, an empty house that you need to decorate. What do you decorate it with? And that's where we get to things like stocks, bonds, cash, mutual funds, ETFs, different types of investments. All of these different types of investments go inside of those different types of accounts. We have retirement accounts, we have non-retirement accounts. Last week, we talked about different things like savings accounts, brokerage accounts, and investment accounts. This week, we're talking about IRAs, 401ks, and 403bs. Inside of all those accounts, you get to choose how your money is invested. Something that's important no matter what kind of investor you are, and even if you don't know what kind of investor you are yet, is two things. Number one would be diversification, and number two would be risk tolerance. Diversification is the old school of thought that you don't want to put all of your eggs in one basket. You don't want to take all of the money that you're taking for retirement or into your savings and put it all into one type of investment. You don't want all of your money in cash. You don't want all of your money in real estate. You don't want all of it in a single Apple stock. You want to diversify. You want to have a little of this, a little of that. So when one thing does good or one thing does bad, hopefully they even each other out. And over long periods of time, you can continue to grow and make money. Risk tolerance is important too. No one person is the same as anybody else in terms of how much risk they're willing to take with their investing. You can be ultra conservative. Ultra conservative would be somebody who keeps money in cash and doesn't earn anything on their money. You can be all the way up the spectrum to ultra aggressive. Somebody who's very speculative, invests in things like cryptocurrencies or very risky penny stocks. And all across that spectrum are different areas where you're able to find yourself falling. Moderate, conservative, aggressive, speculative. And through bonds, stocks, cash, ETFs, these different types of investments, you can build a portfolio that matches your risk tolerance and your emotions and how you handle seeing things go up and down in value. If you're not sure how to approach that, we're going to talk about it a little bit in the next few slides. So let's start with stocks. We've all heard of stocks before. There are different indexes like the S&P 500, NASDAQ, Dow Jones. You may have heard of these. They track different companies. A stock is a percentage, a small little teeny percentage ownership of a public company. They can be volatile, right? So if you own a share of Apple stock, if Apple has bad earnings or gets bad press, the stock could go down in value. If they come out with an amazing new product, the price of the stock can go up and you can make a ton of money. you own a part of the company when you own a share of stock. There is risk involved. A stock can go up in value, it can go down in value. So it's important to understand how different companies react based on different earnings, news, and things that cause them to go up and down. There are really small companies that have stocks, what we call small cap stocks. Then there are mega cap stocks. When you think of a mega cap, we would think of a Google, we would think of a General Electric, Coca-Cola, and then something really small might be just a teeny fraction of that. So it might be much more volatile when you invest in it. There are a lot of things that, again, will cause a stock to go up and down in value. And there are stocks that can be aggressive, moderate, or even more conservative, depending on the kind of company that they are. Bonds are actually debt. Stock is ownership in a company. A bond is debt. There are corporate bonds, there are government bonds, and there are municipal bonds. Let's say I live in Merrick, New York is the name of the town that I live in. So let's say Merrick, which is the town of Hempstead, needs to redo the sewer system. How do they do that? How do they pay for that? They issue what's called municipal bonds. They go to the public and say, we are issuing $100 million in bonds. You give us $100 million. We're going to give you a note that says, I owe you. And it's going to say, I owe you this amount of money over this amount of years at this interest rate. So we want to know things like credit quality. Is the town of Hempstead trustworthy? Are they going to pay me back over 30 years? Or could they default on their money? Same thing goes with corporations and governments. Whenever they need to issue something or need to raise money, they might issue bonds, which is an IOU. So things that come into play, how long it takes for them to mature, whether it's days, weeks, months, years, decades, how much they're paying. If I lend you, the government or this entity, a certain amount of money, how much are you willing to pay me in interest for borrowing my money? And does it make sense to me? There's an inverse relationship between yield and price in bonds. As the price of a bond goes up, its yield or its interest goes down, and vice versa. That's a complex conversation that could actually take hours for us to go through. So we're just going to move on. Bonds versus bond funds. You can buy individual bonds from a municipality, a government, or a corporation, or you can invest in a bond fund. So in retirement accounts, we usually see bond funds, which is basically a bucket that you're investing in, and we'll call the bucket the XYZ fund. And this XYZ fund is a bucket of hundreds, if not thousands of different bonds inside of it, and it puts them all together, and they all have different maturities, different yields, different interest, and it creates an investable asset for you. So that's normally what you see inside of a retirement account. We're all familiar with cash. Cash you can just keep in the bank where you're going to earn a low interest rate. You can keep it under your mattress, which I don't recommend. There are things like money market accounts inside of your retirement account. There might be a money market account, which will offer you an interest rate, and that's just sitting in cash. There's no volatility. It's not going to go up and down in value big like a stock or a bond. It has an interest rate, and that is what you're going to earn on the money. So if the stock market drops big, you know what your interest rate's going to be, and it's not going to affect you. So if you're super risk averse and you're very conservative, a money market account can be a good fit for you. There are interest-bearing savings accounts, and just remember, interest rates change all the time. Something that you'll most likely see inside your retirement accounts are ETFs and mutual funds. ETFs and mutual funds are buckets. They are indices, or they are pooled investments that allow you to track different things. So for instance, there might be the large cap mutual fund or the large cap ETF. You're buying a bucket of funds, a bucket of stocks, of bonds, of different alternatives, and it's diversified for you along that target investment that you have. These are a great thing inside of your plans. ETFs are generally low cost, and they provide some diversification for you. They're not too expensive. And there's something called passive or active investing, which you might need to know about. Passive investing is when you invest in a broad array of different stocks or bonds or cash or alternatives that you're trying to accomplish a certain goal. So if I'm trying to have a growth account, I might buy a growth retirement fund, and that's passive. It just sits with a certain set of funds and doesn't really move. Active investing is when you have a stock picker, somebody who's actually picking this stock or this bond and trading this and selling this. It's active investing. There's a difference between them. Active investing is generally more expensive, and an argument can be made on both sides which one is better for an investor. We'll just talk very quickly about cryptocurrency because it's a hot topic. Cryptocurrency does have a place in the investment spectrum, in the investment world. Something to remember, there are tax implications. So if you're selling NFTs, non-fungible tokens, if you've minted any art, if you are accepting Ethereum or you have an Ethereum wallet, remember that anytime you trade that money into fiat currency, it is a taxable event, and it has to be disclosed to the IRS each year. So I know a lot of artists that are involved in NFTs. Make sure you understand what your tax implications are. Cryptocurrencies are speculative. They've had good periods and they've had bad periods. So just know, if you want to invest in cryptocurrency or NFTs, it's very volatile, and it should just be a portion of your money, not all of it, maybe a small portion. If you're looking for things about how to make money through NFT or through cryptocurrency, there's a lot of great articles and resources. If you have any interest, you let me know and I'd be happy sharing that with you. For those of you who are new to the stock market, and we're getting towards the end here, I just wanted to show you over 100 years, 100 plus years, what the stock market has done. And if we drill down into short periods of time, 10-year increments, you see a lot of volatility. You see up, you see down, up, down, up, down. But as we kind of take a step back and we look over any 20 or 30-year period, if you're somebody who's saving for retirement, that's the way that you should be looking at the growth of your account and the growth of the market. Ignore the little years in between where there's big downs and look at that long term. Because in the long term, the market generally will go up, but it's a matter of managing your emotions and watching those rides up and down in the stock market. If we look over 90 years between 1926 and 2015, this is the performance of your investments in the stock market if you had invested in the S&P 500. And you can see when we look really closely at daily or quarterly or yearly returns, we never really know what's going to be. We could make money, we could lose money. But as we zoom out over longer periods of time, 5 years, 10 years, 20 years, over any 10-year stretch in the stock market, 94% of the time after those 10 years, your account would have been worth more money if you'd made no changes and just let it sit. Over any 20 years between 1926 and 2015, over any 20 years, 100% of the time, the market was higher after the 20th year than it was when you started, barring you making any changes to the account if you just let it sit. So that's the most important thing when it comes to saving for retirement, is kind of set it and don't touch it. Let it sit, ignore the noise, and know that this is money that you're saving for a long period of time to get you through retirement later in life. Risk tolerance is important. Everybody's different. Here's a great link for anybody who'd like to take a risk tolerance questionnaire. It'll kind of help you figure out where you fall on that risk spectrum. If you're somebody who's maybe super conservative and should just be in cash, if you're somebody who's moderate, you should have a nice blend of stocks, bonds, and cash. Or if you're somebody who's super aggressive, who might want to take a risk and try to take a swing and see what they could do in terms of growth and having their account perform over long periods of time. So everybody's different. This is a great place that you can go to check that out. Last thing here, estate planning, and I'm just going to touch on it quickly. There are 3 things that are really important for your estate: a will, a power of attorney, and a healthcare proxy. Your will basically say when you die, who gets what. Power of attorney If you are unable to sign legal documents for yourself, who has the power to do so? Healthcare proxy. What are your medical directives and wishes? It's important to have these things written down. It can be a pain to go through it and spend an hour or 2 hours getting it listed and sorting it out. But it is important if you have children or family that you want to take care of and make sure things are in good order. You can visit Rocket Lawyer or LegalZoom.com, and they offer estate planning packages that will walk you through all of this and guide you through it. It's important to do. If not today, tomorrow. You can do it online or with an attorney, but it is something that I highly encourage everybody to think about doing. If you ever have any interest, I participated in the writing of a book with the Foundation of the Arts called The Profitable Artist. It's a great thing for anybody who is a solo artist or starting their own business in arts or creative space. It talks about different ways to be able to manage your business from marketing, finance, accounting, everything like that. So we'll turn it over to questions and answers. I know that, again, we have limited time here, and we went through a lot over these last 2 sessions, and there's a lot more to cover. So if anybody has any questions that they'd like to throw out there that might apply to the group, and if not, that's okay too. But go ahead and share it in chat, and we'll try to get to it if we can.
Julian, thanks so much.
You're welcome.
Feel free to put your questions in the chat. Like Julian said, I know we're a little bit over time. I appreciate everyone's attention in the Zoom world. And I just want to say a couple things in closing as well. Thank you to Aisha, amazing to watch. Julian, thank you for your expertise. Natalie, thank you for your support. Natalie is going to drop in the chat an evaluation survey. It takes 2 minutes. It will help us know how you felt about today's session and what you want for future sessions. And we definitely read them. So please fill it out. Natalie's going to put that in the chat and also came in your email
Jennifer,
packet. Yep. Go ahead.
There was a couple of questions in the chat. If it's okay, maybe I could just spend a few minutes just running
Perfect.
through them.
Go
So
for it.
first one I came through
Yep.
from Letitia looked like thoughts about different types of investing apps. They're all different types of apps. There is Robinhood, Acorns, even things like TD Ameritrade, Fidelity, Schwab. There's all different platforms. The best thing to do is find one that offers potentially commission-free trading and also provide some education. So I know TD Ameritrade and Schwab have really great broad platforms that allow you to trade and also provide a lot of different education to make it simple when you're buying, you're selling. You want to know the difference between a limit order or a market order. A lot of times on the smaller apps, they don't provide the education, and people sometimes can make poor choices there. So I do recommend TD Ameritrade and Schwab. I have no affiliation with them, but those are just 2 apps that I do like. Voice point that you recommend. So another question here from Wednesday was, with so many expenses for artists, is there a certain point that you recommend reaching before opening a retirement account? No, I recommend opening a retirement account today if you don't have one. Even if you only put away $5 a month, start with something. It creates a culture of savings. It's exciting putting money away and seeing it grow. It allows you to dip your toes in the water. And it allows you to enter in a line item on your budget so that as you're building out projects, you're getting paid, you're figuring out your expenses and your budget, you know that you're keeping something to the side for retirement and for paying yourself. Again, don't worry about reaching the maximum. Don't worry about putting away $6,000 or $20,000. If you could put away $100, it's a start. Start today, and it'll help you with taxes and it'll help you with your future. Those are the 2 that came through, Jennifer, so I'll turn it back to you.
That's really great. And I just want to also say thank you everyone for coming, because it's not easy to talk about money. And I totally agree, just start saving, start planning. We all know from COVID that if we didn't have any savings or an emergency cash, it was a very difficult time. So on that front, we also have these consultations that Julian has offered. In the chat, Natalie has put the sign up for the consultations. We have 10 of them. They're free. They're only on Friday, June 25th, between 10 and 3. So that survey, that sign up is going to close at 7 o'clock tonight. Then staff and I are going to look at it, see who fits into what time zone. Make sure you have a question that you think is appropriate for Julian to answer, particularly about money and money and money. And then you're going to hear from Natalie at thefield.org tomorrow, probably afternoon, if you've gotten a slot. If you haven't gotten a consultation, I'm sorry. We only have 10 and there's 20 people here and there are 20 people in the other session. But most likely we will do this again with Julian, and we'll find, different ways to support your learning and growth in this area. So,
and I would just also
Yeah.
recommend, if anybody has specific topics that they feel would apply to a group that we may have missed between the first session and the second session, please let Jennifer and the team at the field know, so that as we put more of these together in the future, hopefully we can cover some of those topics.
Absolutely. Thanks everyone for being here. Go ahead, do that survey, fill out your consultation. Julian, thanks so much. Aisha, thanks so much. Have a great night, everybody. Save your money. Save your money. Good night.